What's up, everybody? Um, Today we're gonna do a little teaching. Class is in session. What do you know about the stock market? I said I was gonna do a series talking about basics and knowing about basic things. Um, and I talked about hard skills, soft skills. I talked about financially, personally, professionally. Well, let's deal with some of that financial stuff today. What do you know about the stock market? Welcome to the Blacksmith Podcast. I'm Will, your host. Over here, we forge men, and we're going to start forging right now. We're about to get down to it. So, what you're looking at right here is my Robinhood account, right? But more specifically, you're looking at Earn, Ellington Credit Company. See, the ticker right here is Earn. We ain't going to sell Earn, but let's go over what you're looking at. Now, Robinhood is a platform where you can buy, sell, trade stocks. You can do options, all kinds of stuff, right? But if you don't know anything about stocks, Robinhood is a good one to get into because number one, all you have to do is input your information. You have to have a bank account. You've got to ensure that you identify yourself, stuff like that. But then they give you a free stock. They give you a free share of a stock, and it's random, so you don't know what it's going to be. It's not going to be a 400 and something dollar stock like Microsoft. Maybe it's down to 300 something, but you get what I'm saying. It'll be, $15 stock, $25 stock. And guess what? You already have equity in the stock. So if they gave you a share of a stock that was trading at $25 right now, right? Your equity in it is $25. Why? Because you didn't buy it, it was free. So if you sold it right when they gave it to you, which I wouldn't advise, if you sold it right when they gave it to you, all that whatever it says it's trading at is what you get because it cost you zero. That's how stocks work. Consequently, let's say you bought another share of that company. So now you have two shares at an average of $25, right? Because one of them was free. Well, I guess it'd be at an average of 12.50, but you get what I'm saying. One of them was free and one of them was $25. So then if you sold it, um, you would only get $25. You get half because one of them you don't have any equity in, and the other one you do. Anyway, hopefully that makes sense. If it doesn't make sense, let me know in the comments, okay? So what you're looking at is what I like to what is considered a REIT, right? It is a real estate investment trust. So let's do a little teaching here. I should have had this pulled up already, um, but I didn't. So a real estate investment trust right here, right? It's a security that trades like a stock on the major exchanges and owns and in most cases operates income producing real estate or related assets. Many REITs are registered with the SEC and publicly traded on a stock exchange. Let me break all that down very quick. We going forge today. I would say cook, but this is not a kitchen. This is my office, and you see my cover photo, right? It's a blacksmith pounding a piece of metal on the anvil, forging. We forging today, all right? So, what a REIT is, real estate investment trust. If you don't have the money to invest in real estate, like $400,000 to buy a house, right? You can have the money to invest in a company that invests in real estate, income producing real estate, right? My screen's over here with it up. So if I'm looking over there, that's what it is. I got to teach myself because it's also it right in front of me. I got dual screens running, but I'm new at this. I don't really do the screen share thing. So just work with me here. Don't critique me too hard. And then my camera's in the middle. So you got left screen, right screen, camera. So I'm looking here, looking at myself on the screen, but the camera's here. So work with me. We're forging today. All right, we ain't got time for silly stuff. All right, so another thing about REITs, right? They are federally mandated, right? To get up. I'm getting ahead of myself, but here we go. I was about to tell you. REITs are structured as a corporation, are typically not taxed at the entity level, which allows investors to avoid double taxation on dividends. We'll get into that in a second. This is why I'm teaching you about REITs. We're going straight to it. We forge into that. REITs must invest in real assets and derive the majority of their income from real estate activities, including rents from properties and interest from mortgages. The REIT must also pay out, this is what I was just saying, 90% of its annual taxable income to the shareholders. I know it says dividends in dividends, but who's getting the dividends? Not people who don't own the stock, people who own the stock, the shareholders. Due to this structure, they typically pay out a higher rate of dividends than equities or many fixed income investments. Dividends received from REIT holdings are taxed as regular income. Okay, so but now let's break this down, right? I missed this part right here. So I read the up to the stock exchange. These are known publicly traded REITs. Others may be registered with the SEC, but not publicly traded. REITs receive special tax considerations and typically offer investors high dividend yields as well as a liquid method of investing in real estate. See that? Why should you invest in REITs? I'm going to explain it to you now. Okay. And we're going to get deep into the investment game. All right. I may be an active duty Navy chief, but that is not all I do. I'm a blacksmith and this is my forge, and we forging today. Let's go. So, this is why you should have REITs. First of all, why should you invest in stock? Let's take a step back, a gigantic step back, right? Why do you need to invest? Well, I got a question for you besides that. Do you want to work until you die? Look me straight in my brown eyes. If the answer is no, that's why you need to invest. Got it? Questions, comments, concerns? If you don't want to work until you die, then you need to invest. Let me break it down further because all of us ain't there yet, right? We haven't all arrived at this realization that unless you stop trading time for money and make your money work for you while you're asleep, let me not steal his thunder. The great, not yet late, Warren Buffett said, you will work until you die unless you find a way to make money while you sleep. I think I butchered it. He said if you don't find a way to make money while you sleep, you will work until you die. That's what he said. Warren Buffett. Great, not yet late. Tongue twister. Okay? What does all of that mean? Think about what you do, right? There's 168 hours in a week, right? Let me see if I'm correct here. I don't want to get this wrong. I'm pretty sure about that. Not 7, times 24. Yeah, 168 hours. Right. 168 hours in a week. We forging. We forging. We ain't got time for silliness. Critique if you want to, but keep watching and keep your ears open. Okay. So you got 168 hours in a week. 40 of those are for work, right? The average work week, 40 hours a week, right? 8 hours a day, 5 days a week. That means that you must be at work in order to earn money. I'm not talking about vacation time, none of that stuff. I'm talking about if you are paid hourly, then you have to be at work to earn money. If you are paid salary, it's a little different, but it's the same concept. If you're taking time off that you don't have, like vacation time or sick time, guess what? You can get fired. So essentially, salary, hourly, you're trading time for money. I'm doing it. I'm on salary in the Navy. I'm a Navy chief. I'm on salary. Whether I'm on leave, whether it's an off day, I'm earning because I'm on salary. Hourly, I used to be hourly. You have to punch in and punch out. As soon as you punch out, you stop earning, period. Right? But we're in this together because we're still trading time for money. Now, let's get to it. We're forging today. All right. I want to say cook because I love using that. I don't use the term, but I love it when people say we're cooking today. This is not a kitchen. This is my office. This is the forge, and we smithing today. We forging. All right. So look, let's say you had $1,000 in your bank account, right? A lot of us are like, yeah, I wish. All right, just go with me here. Let's go. Let's drop it to 100. What is the average rate of inflation? 3 to 4% a year, right? Notice what I'm using, right? I'm just using Google. I'm just using Google. See this? This is all provable. It's out here for you. Average rate of inflation is 3 to 4%, right? So 3.2, 4.0. Let's just use 3 to 4%. But let's go on the low end, and you can see this is from Federal Plan Bureau, whatever that is. I don't know. AI is saying 3%. Inflation calculator 3% for 12 months. Okay. You can just scroll here without even having to click. It tells you it's 3 to 4%. I already knew this though. So the average inflation is 3 to 4% a year. What does that mean? That means if you had $100 in your bank account, we forging today. Um, at the end of the year, you'll still, or the beginning of next year, January 1st of next year, 2025, you still have $100 in your bank account, but it spends like 97. The the value of the dollar went down. Inflation went up, which drove the value of the dollar down, which means you still on paper or electronically, if you log in, you still got $100. You still have $100 in your bank account. It spends like 97. Now let's go back to the 1,000 I gave you in the first place that you were, I wish, right? Some of us do, right? I'll take another 1,000, whatever. But you would still have $1,000 in your bank account. If you had it January 1st of 2024, you still have 1,000 if you didn't spend it in your bank account January 1st, 2025. Guess what? It spends like 970 because eggs went up, milk went up, gas went up, utilities went up, internet, cable, water, trash, all of that stuff. The cost of engine oil, tires, everything went up, which means the value of the dollar went down. If you guys do your research, right, back in the 1800s, they used to take wheelbarrows full of dollars of money to the store to buy groceries. The dollar was worthless, virtually worthless, right? And then they started backing it on the gold and all that kind of stuff, but not to get too historical. But it had to be backed on something better than what it was backed on. So now let's fast forward. Let's come back from that, right? The dollar becomes more worthless every year. So if your pay stays the same, you earn 50,000 a year, right? You'll still earn 50,000 a year, but if you do the math, well, I can't even do that. Let's say you took home 50,000. Let's just do the math off the bank account. So if you had 1,000 and it spends like 970, well, 10,000 is gonna spend like 9,700, 9,700. 100,000 would spend like 970,000. You see, it breaks your heart every time you add a zero just a little more. Would you want $100,000. I did that wrong. Jesus, Mary, and Joseph. Okay. $100,000 is gonna spend like $97,000. We forging today. We ain't worried about all that other stuff. Critique me later. All right. $100,000 is gonna spend like $97,000. Okay. But if you have $1,000,000, it's gonna spend like $970,000. Does that make sense? It breaks your heart a little more every time you add a zero. Don't don't mistake me screwing this stuff up for not knowing what I'm talking about. I actually know what I'm talking about. You get in front of a camera and try teaching people. And that's all I'm going to say about that. I can't worry about critique because there's students that want to be forged out here that's listening, okay? Put it in the comments. Let's have a dialogue. Anyway, so your salary does the same thing. So if you were earning $100,000, if that was your take home, and your salary staying the same, do the same thing for your salary as you would do for the bank account because of inflation. Get to the point, right? Okay, so you have $1,000. It's time for you to change your mindset. It first has to start up here, folks. Okay, what is your mindset? If your mindset is not, check my time. If your mindset is 9 to 5, congratulations, you will work until you die. And most people will, okay? So just keep it real with you, okay? While forging, yeah, I'm gonna have to always keep it real, right? Part of the forging process is that you smelt down the ore and you heat it up really, really hot so the impurities and all the dirt and all that kind of stuff will burn out of it. So it will shine bright like a diamond. So you just have enriched whatever metal it is, iron, lead, copper, whatever. You just have rich 100% gold or whatever you're dealing with, right? So we're not going to lie to you. We're going to give you the truth. You need to start looking at every single one of your dollars like an employee, okay? If you have $100 sitting in that bank account, they are, and I'm talking about a savings, I'm talking about a checking, and don't come to me, well, my savings got a 0.25% interest, so I made some money. Get out of here. And how much money did you make? They deposited 1 penny into your account, right? So is that going to help you not work until you die? So that's not apples and oranges, okay? Let's not play semantics. Let's not play games. Checking and savings, virtually, you get nothing for it, right? So it sits there and it does nothing. That's like having a business and having 100 employees sitting in your break room. If anything, right, some of these, they're just drinking from the water jug. They're hitting the fridge. They're telling jokes. They're getting money out the vending machines. It's shrinking a little bit. Some of them, I don't know. Some of them are asleep. Get what I'm saying? They're not doing anything. What business owner would allow 100 employees to just sit in the break room and not earn them money? You are the first business you need to worry about, not Amazon's, not the ones you work for. You're going to work for them, but if you don't also treat yourself like a business, you're going to work until you die. We forging today. You hear that? I'm hitting the table with authority. We forging today. All right, so look. So how do you put them to work then? You have to invest them. And what is investing? That is putting your money into something, putting it to work where it is earning money versus losing money. Let's take it a step further because that's basic knowledge. Let's go intermediate with it, right? Putting your money to work, earning more than inflation. That's investing. Because if you only earn 2% from a share certificate / savings CD, you're still losing money. That's not an investment. When inflation is 3 to 4% a year, so worst case scenario, it lost 2% of its power. So $100 now spends like 98 because you gained 2% and you lost 2%. I'm sorry, you gained 2%, you lost 4. So it puts you at a 2% deficit, right? So you have to think about it. If a savings CD is going to give you 5%, no matter if it's 3 or 4%, that's an investment because it's a very small one. So don't expect small investment, small mindedness will lead to small investments, will lead to a small return. Okay. So you got to think big. Okay. I'm showing you how. Okay. I got 10 minutes on this video. All right. So we're going to have to do a part 2, but I'm just letting you know small mindedness is going to lead you to small investments, which will lead to small return. If you want big returns, you got to expand your thinking. You got to be like Einstein when it comes to this stuff, and you owe it to yourself. If you want to retire at 40, that's a dream for most people. It's not going to happen. I'm going to tell you right now. You want to retire at 50, a little more workable. 60, a little more workable, right? But it's you that have to retire yourself. I'm not talking about getting to 40 years on a job. I'm talking about making moves on this screen and knowing about this kind of stuff that's going to set you up for success. You have to retire yourself. All right? Let's get back to it, right? So that $100, if you put it to work in a savings CD that's 5%, you earned, at worst case scenario, 1% on your money. But now let's talk about REITs, the reason I have them pulled up, okay? Real estate investment trust, right? So I just told you what they are. So it's a stock. You can invest in the stock market. You don't have to use Robinhood. I'm using Robinhood. Don't ask me to use Charles Schwab or nothing else. Robinhood. So you type in the search bar, EARN, the ticker's right here, right? And it tells you it's going to bring up Ellington Credit Company, right? That's what it is. Now, it's trading currently right now at $7.02. Actually, the stock market's closed because right now I'm on the West Coast. It's 5:07 p.m. So the stock market's closed. So now you can look at the history of the stock. All time, the stock has lost money. That means this IPO'd at $19. Because if you add 1198 to 702, IPO means it entered the stock market worth $19. Okay. So over time, over the max amount of time that this has been a company, it's actually lost money. That's a bad sign, right? Then if you go to 5 years, you can see it lost 391, 35%. That's a bad sign. If you look in the last year, it went up 1%. Okay, that's a good sign. Now, 8 cents is not a lot, but look, the stock is very low. When you got stocks out here like Nvidia that was $1,200 before it split, you had stock out here like Amazon that was $3,600 at least before it split. So just go with me here. If you don't know nothing, pay attention. You're going to know everything. If you look year to date, so this day last year, it has gained 15%, almost 16, almost a full dollar. In the last 3 months, it lost almost 1%. So the year to date, 1 year, that's a good sign. The stock market over the last month has fallen. So it lost, look, not even worth mentioning. In the last week, though, it's made 3%. And today, come on, today it made a quarter. Okay, so 26 cents. So it's up 364. Now let's get down here to the nitty of the gritty. So this is my portfolio with Earn. So my market value right now is $6,348.22. That means if I sold this right now, this is what will be deposited into my account. Okay. I would sell and that's what I would get. Now, today's return, I made 4%, 4.5%, $271. And total return from when I bought it. Now, where do you get that from? So I have 904 shares, 0.304448 at a cost of 651. The stock is up to 702. So what does that mean? On every share, I have made 51 cent, right? So you take that 904 point this, multiply it by the 51 cent, there's my total return right there. Okay? So from the time I bought it to right now, I've made 7% off of this. And I've had this for a few years. Um, but, and it's 12% of my whole portfolio. This is just one of the stocks that I have. Okay. All right. So now this is the real reason why I wanted to show y'all this. Do you see this? Dividend from Ellington Credit Company. It will hit the bank account in 13 days. 72.34. Okay? That's not a lot of money, right? Closed-mindedness, right? Because let me show you something. I got a couple minutes to do it, and it's gonna have to be a take two on it. Not a take two, but it's gonna have to be a part two on this. Now, let me show you something. For all you people with the small mindedness, look at this. My first shares of Ellington Credit Company was 10 shares at $11. See, I bought it when it was higher, $4 higher, right? And then I bought some again the next month. My first dividend was $3. See that? Then I got another dividend. Oh, no, I'm sorry. It reinvested right here and it bought me almost a quarter of another share. So why is that important? You have drip on. It's like, don't get me the line. It's not dividend reinvestment program, but that's pretty, it might as well be that. It stands for something. The D stands for something I can't remember. For the sake of time, drip. Always have drip turned on. Just think of it as dividend reinvestment program because that's what it does. If you have it turned on, any dividends you get from your stocks, instead of depositing into your bank account, which you can do, instead of depositing it into your buying power, which you could do, you deposit it directly back into, you let it reinvest back into itself. So I had that turned on. I've always had it turned on, and it bought me a quarter of another share. Now, why is that important? Well, there's 4 quarters to the year, right? So if you think about it, if you let it reinvest all year, every quarter, because, most stocks, here's another reason why REITs. I'm going to get this all together in the next video, right? Most stocks report their earnings quarterly and they only pay dividends quarterly. If they pay dividends at all, most stocks don't even pay a dividend. A dividend is nothing but giving some of the money they earned in that quarter to their shareholders, anybody who owns one of their stocks, right? But again, you saw REITs are federally mandated to give 90% of their profits to the shareholders. But they're not worth very much, but you don't buy them for the amount that they're worth. You buy them for this. I've made way more money off the dividends than I do than I've made from what it is appreciated from. What was it, 400 and something dollars, maybe? Something like that. But anyway, I want y'all to look at this. You see me scrolling, right? They see me scrolling. Don't be hating. $3 ain't nothing to hate off. Okay, so $3 here, $3.02 here. And as I buy more or I let it reinvest, $3.08, $3.11, $3.20. It ain't much, right? It's really not much. And so then, but you scroll up, right? You keep it going. I bought more right here, 30 shares at 196. This was in 22. I was on deployment actually. Now it's up to $5.50, all the way up, all the way up. Okay. Now we're getting 18, all the way up to $72. That's powerful. I will see you in the next one because there's got to be a part two.